Well, good afternoon, ladies and gentlemen. Welcome to our indexuniverse.eu webinar on regulation and exchange-traded funds. This is perhaps one of the key topics of the year for anyone involved in this market. We've seen a blitz of pronouncements on ETFs from global regulators, those at the regional level, also national regulators. So in the next hour, we're going to look at the existing framework for ETFs in Europe, how they operate, what the laws are, and then we're going to look at what might change. We're also going to have a 30-minute question and answer session. We've invited two active investors in ETFs to share their views on the topic, and we will try to draw some conclusions about what might need to change in the way the ETF market operates in Europe. My name is Paul Amery. I'm the editor of Index Universe in Europe and also of our print publication Journal of Indexes Europe. I'll be moderating today's webinar. I'm joined by three expert panelists. Brian Kelliher is a partner in Dillon, Eustace in Dublin, law firm. He will start our webinar by describing the existing framework for the regulation of ETFs in Europe. I'll then spend around 15 minutes reviewing the comments from regulators that have been coming out over the last year or two on ETFs, and also look at what might be about to change in terms of ETF regulation. And then we're joined by two investors, Alan Miller, who is founding partner and chief investment officer of SCM Private, and by Gary Mairs, who's founder of TCF Investment. Alan and Gary will be sharing their views as investors in ETFs on the topic. Before I hand over to Brian, I'd just like to remind everybody listening in that webinars are meant to be interactive. So please ask any of our panelists, or all of them, your questions, and you can do so at any time during the next hour. It's very easy to do so. You just click on the question mark icon on the floating toolbar, which opens the Q&A window in the lower right-hand corner of your screen. You can type your question into the small dialog box and then press send. And then I will moderate and pass on your questions to the participants. And with that, over to you, Brian.
I'm going to focus on the UCITS requirements applicable to ETFs from a European perspective. And in this regard, I'm going to give an overview of the general UCITS restrictions, the rules relating to the use of derivatives, applicable obviously to synthetic ETFs, the rules relating to collateral in order to reduce OTC counterparty exposure and securities lending. So to begin with, I'm just going to focus on the general UCITS restrictions. And most of you will be familiar with the general diversification requirements applicable to UCITS, the main one of which is the 5-10-40 rule. And this basically provides that exposure to any one issuer cannot exceed 10%, and the aggregate exposure to any one issuer between 5 and 10% cannot exceed 40%. But interestingly, there are more flexible risk-spreading rules applicable to index replicating funds comprising transferable securities such as equities or bonds. And in those particular funds, the UCITS is allowed to have exposure of up to 20% in any one issuer, with a maximum of 35% in one particular circumstance, in one particular issuer, where there are exceptional market circumstances. So the situations where you can do this is where the index meets certain criteria. The first is that it's sufficiently diversified, which is a reference to the 20-35 rule I mentioned. So you'd look for the weightings of the constituents not to exceed 20%. And with at least one of them, with not more than one of them exceeding 35%. The second is that the index must represent an adequate benchmark for the market to which it refers, which is really focused again on the methodology being used and ensuring that no one major issuer is excluded from the market to which it refers. And the third criteria is that the index must be published in an appropriate manner, which is a reference to the fact that it should be accessible to the public, and also that the index provider should be independent of the UCITS. So essentially this is the main rule that's applicable to UCITS ETFs that physically replicate an index. Turning to our next slide and focusing a little bit more on the synthetic ETFs, the Eligible Assets UCITS Directive I suppose endorsed the use of derivatives in order to replicate the composition of an index. And therefore we're seeing synthetic ETFs more prevalent recently. And in this context, from a European perspective, the relevant rules relating to the use of derivatives are, firstly, that the underlying must be eligible from a UCITS perspective, or be a financial index, an interest rate, foreign exchange rate, or currency. Secondly, the counterparty to the OTC derivative transaction must be an institution subject to prudential supervision. And thirdly, the OTC derivative must be subject to reliable and verifiable valuation on a daily basis, and must also be capable of being sold, liquidated, or closed out by an offsetting transaction at any time at its fair value. Moving to the next slide, and the use of financial indices. A financial index can be used, as I said, as an underlying of a derivative, and there can be used to seek exposure or to replicate a particular index. As we'll see later on, one of the main rules applicable to derivatives is that you need to look through the derivative to see your exposure to the underlying assets and ensure that any indirect exposure you have through the use of derivatives combined with any direct exposure you have in the UCITS itself comply with the 5-10-40 rule. However, if your index complies with the criteria on your slide A to C, which I previously referred to, then you do not have to look through the index, and furthermore, you can avail of the more flexible diversification rules, which are the 20-35% rule that I mentioned earlier. Indices based on financial derivatives on commodities or indices on property are eligible provided they comply with the criteria set down above in the slide. And in addition, in Ireland, financial indices must be cleared before they can be utilised by the fund. And in this sense, the regulator does not require the index to be cleared by them if it comprises of eligible assets such as stocks and bonds, and it meets the 5-10-40 rules. So in the context of a replicating fund, if the index, the weightings of the constituents of the index meet the 5-10-40 rule, and your index comprises of eligible assets, you do not need to have it cleared by the regulator. Obviously, with an index comprised of ineligible assets, it would need to be cleared by the regulator and would therefore need to meet with the criteria set out from A to B in this slide. If the financial index does not meet the criteria and it's comprised of eligible assets, well then you could still utilise the index provided that you look through it and ensure that there's compliance with the 5-10-40 rule. In relation to, I suppose, the restrictions relating to the use of derivatives in a synthetic ETF, there are a number of rules that need to be complied with. And the first one that I'm focusing on is the global exposure requirement, which provides that the global exposure as a result of the use of derivatives cannot exceed 100% of the NAV. And in global exposure in this context is the incremental exposure and leverage generated by UCITS through the use of derivatives utilising the commitment approach. It's also a reference to the market risk of a UCITS through the use of derivatives utilising the VAR approach. So on this slide, you have the various limitations depending on whether you're using the commitment approach or one of the two VAR approaches, which is the relative VAR and the absolute VAR. On the next slide, I have set out the quantitative parameters that are applicable to the VAR model, whether that be the absolute VAR or relative VAR model, and most of you will probably be familiar with those. Other restrictions applicable to derivatives are the position concentration rule, which I referred to previously, and in summary, again, one needs to look through the derivative to see what your position exposure to the underlying is. And when you combine that exposure with any direct exposure that the UCITS may have to the same underlying, you need to ensure that it complies with the 5-10-40 rule. And as explained, the one exception is where the underlying derivative is a financial index, and that financial index meets the criteria I referred to in previous slides. In that scenario, you do not have to look through the financial index, and you just need to ensure that you comply with the 20-35% concentration rule. The cover requirement is a requirement relating to having sufficient liquid assets to cover any commitments as a result of entering into a derivative transaction. So if there's a derivative and it's marked and it's out of the money, and you potentially have a commitment to pay money to your counterparty, you need to have sufficient liquid assets in your portfolio to cover that commitment. And finally, the OTC counterparty requirement is a reference to the exposure you can have to your OTC counterparty. So essentially, if your derivative is in the money and there's a positive mark-to-market value, you need to ensure that that exposure doesn't exceed 10% in the case of credit institutions and 5% in all other cases. So turning to the rules relating collateral, as mentioned, the counterparty exposure rule is 10% in the case of a credit institution, or 5% in all other cases. But it is possible for the OTC counterparty to post collateral with the UCITS in order to reduce the UCITS exposure to that counterparty. And in Europe, under the UCITS directive, there are particular rules applicable to the collateral that can be taken to reduce the counterparty exposure. And as you can see there, we have a reference to liquidity, which is a requirement that the collateral be capable of being sold quickly at a robust price that is close to its pre-sale revaluation. There's a reference to valuation in the sense that the collateral must be capable of being valued on at least a daily basis. There's a reference to issuer credit quality, which is focusing on the credit rating of the collateral issuer. And it also acknowledges the fact that haircuts may be applicable in the event that that credit rating is not high. There's a reference to correlation in the sense that there should be no relationship between the OTC counterparty and the collateral issuer. And there's a reference to collateral diversification in that there should not be a concentration to any one issuer, country or sector. And finally, there's a reference to operational legal risk in the context of collateral management. Other requirements from a European perspective is that the collateral must be held by a third-party custodian, which is subject to prudential supervision. There is also a reference to that the collateral must be fully enforced by the UCITS at any time without reference to or approval from the counterparty. Non-cash collateral cannot be sold, reinvested or pledged, and cash collateral can only be invested in risk-free assets. And there's also a reference to discount rates where there's volatility in relation to the price of the actual collateral. So I suppose in the example of a fully funded total return swap where collateral is posted with the UCITS in order to reduce the counterparty's or the UCITS exposure to the counterparty, that collateral would have to meet these principal requirements as set out in these slides. So turning to securities lending, and I suppose in contrast, securities lending, although permitted I suppose for the purposes of EPM, there are not as many prescriptive rules at a European directive level in relation to collateral received under a securities lending transaction. And so this slide basically highlights the fact that securities lending is discretionary on each home member state, and if they do allow it, they need to allow it and set out the rules they wish to specify. At a European level, securities lending is permissible as an EPM technique, and I set out the definition of techniques used for EPM, and securities lending is generally validated as an EPM technique on the basis that it generates additional capital, which is set out in B3 there on that slide. The only rules at European level applicable to securities lending is that if the securities lending transaction is used in order to generate additional leverage through investment of collateral, that transaction must be taken into consideration for the determination of the global exposure. And you can see from the final point on that slide that in that particular case, the amount received must be taken into account in the global exposure calculation if cash collateral is held, and otherwise the market value of the instrument must be taken into account if non-cash collateral is held. So interestingly, there were no rules at a European level in relation to the credit rating of the securities lending counterparty, in relation to the collateral that's received by a securities lender, and it's entirely left open to each home member state to introduce their own rules. And I just thought for interest that I would set out in the final slides what the Irish requirements are in the context of securities lending. You can see from the slide they're looking for the counterparty to have at least an A2 rating by S&P. the UCITS must be able to terminate at any time the securities lending transaction. They also want the collateral to adhere to certain principles. Some of them are common to those that we've seen on the collateral on the OTC derivative side. The collateral must also equal or exceed in value the value of the amount of securities loaned, which the implication of that is that the UCITS is not allowed to have an exposure to the securities lending counterparty. And the collateral must be immediately available to the UCITS without recourse to the counterparty in the event of default. You can see that non-cash collateral cannot be sold or pledged or reinvested, and the cash collateral can only be invested in certain particular instruments. And then finally, invested cash collateral held at the risk of UCITS must be diversified, and invested cash collateral may not be placed on deposit with or invested in securities issued by the counterparty or related entity. So even though there are no rules at the European level, the Irish regulator has imposed similar requirements for collateral in relation to a securities lending transaction, similar to those that apply to collateral in an OTC derivatives context. So with that, Paul, I'm going to hand back to you.
Thank you very much, Brian. I'd like to focus in the next 15 minutes on a slightly broader overview of what's been going on globally and what regulators have been saying about ETFs, and to try and draw together some thoughts on what might be next. I thought it might be useful to review one by one the warnings that have been coming out from regulators about ETFs over the last couple of years, and you can see on this slide that there have been very many of them, and the first ones really came in the middle of 2009 and had more to do with aspects of investor protection than concerns relating to possible systemic risks that might result from ETFs. The more systemically important risks have been a feature of the regulators' warnings that have come out this year. But I'd like to have a quick look through the ones that regulators have stated both at the national level and at the international level. You'll see that in 2009 there were warnings from FINRA and SEC, the US regulators, about the use of inverse and leveraged ETFs. In early 2010, the SEC in the United States put a temporary ban on the use of derivatives by investment company funds, or funds regulated under the 1940 Investment Company Act, which includes most US-listed ETFs. And that temporary ban has lasted until today. The SEC has a current discussion paper out and is seeking investors' responses over the next couple of months. But we've got a rather strange situation in the US where previously listed ETFs using derivatives are still operating, but new launches have been suspended. Then in last year, we've seen more of a shift towards focus on synthetic ETFs. The Hong Kong regulator came out late last year with a risk warning about synthetic ETFs, and Hong Kong has also moved to impose some new naming rules for synthetic ETFs, requiring them to have an asterisk and the word synthetic in their name. And this year, as you can see from the slide, there's been a whole list of ETF-related warnings, some from the FSA, the UK regulator, the first of which related to leveraged ETFs, the second of which related to ETF complexity. That theme was taken up by the Australian Central Bank in March this year. And then in April, we had a number of different pronouncements on the ETF market from the G20 Financial Stability Board, the IMF, the Bank for International Settlements, who covered a whole range of ETF-related or perceived ETF-related risks, such as conflicts of interest, securities lending, relating to the use of derivatives, and even, and particularly in the BIS paper, drawing out some conclusions about possible risks or broader risks to the financial markets as a result of ETFs. And since then, we've had further warnings from the Bank of England, the Financial Services Authority, even the UK Serious Fraud Office has talked about potential threats from ETFs this summer. And most recently, in July, the new Europe-wide regulator, ESMA, which came into being at the beginning of this year, has put out a discussion paper highlighting certain risks, but also inviting people to comment on potential changes or regulatory changes in the ETF market, and I'm going to come on to those in a few slides' time. What are the common themes of the regulators' warnings? I've tried to summarize them. Well, the first of them, and this is featured in a number of warnings, has to do with the use of inverse and or leveraged ETFs by investors. There's the perception that investors might not know what they're getting themselves into with these types of funds. The second category of risk warnings relates to the use of derivatives by ETFs, and particularly to associated counterparty risks when derivatives are involved. The third category of warnings relates to securities lending. Fourthly, we've got systemic risks of certain types highlighted by regulators. And fifth, people from among regulators have been talking about the potential liquidity risks in ETFs and whether ETFs might be as liquid as they are potentially being made out to be. So I'll run through each of these themes in turn and draw out some further thoughts before turning to the current ESMA discussion paper. On inverse and leveraged ETFs, I think this subject has been pretty well covered by ETF issuers, by market commentators for the last 2 or 3 years. It became very apparent, particularly in 2008 when markets collapsed, that many people had bought, in particular, inverse or double inverse or even triple inverse ETFs and had not received the returns they thought they were going to get. And there's probably been a greater emphasis since then on explaining the natural feature of these funds, which is the result of their daily rebalancing, and that means that you don't get the same return over a period of time as you would get just by multiplying the index by the leverage ratio applied to the fund. In other words, returns as a result of daily rebalancing of inverse and leveraged ETFs, there's a certain path dependency of returns, and the greater the leverage factor applied, and also the greater the volatility of the underlying index being tracked, the greater the potential return drift from what you might imagine as the equivalent multiple of the index return. Now, this has been well highlighted. We've seen in the summer of 2009 many US brokers working with retail clients actually stopped selling leveraged and inverse ETFs to their clients. We've seen a number of steps taken by issuers in Europe to restrict access to these types of funds, putting them behind website barriers that allow access only to professional investors, the addition of risk disclaimers when it comes to this type of fund. But it is a topic that keeps popping up, and it's one that you'll regularly see mentioned as a particular ETF-related risk. But it's very much in the category of investor protection. It's also worth adding that this type of risk is not, what we might call the risk of return drift is not limited to inverse and leveraged funds. Similar properties exist in some commodities trackers when you have to, the index is based upon the rolling of futures contracts, and also in some volatility trackers. Turning to the use of derivatives by exchange-traded funds and the related risks, as Brian has mentioned, Europe's UCITS rules allow ETFs to be based upon the use of derivatives, and in fact around 2/3 of European ETFs, that's by number, slightly less than that if you look at the assets under management, are so-called synthetic ETFs or derivatives-based ETFs. I mentioned earlier that the Securities and Exchange Commission, the main US securities market regulator, has a current ban on the issue of similar funds in the US market, so there's an interesting discrepancy between global regulators when it comes to this type of fund. That's something I'm going to come back to in a second. What are the main perceived risks in this type of fund? Well, clearly you have if a derivatives contract is involved and it's an over-the-counter derivative conducted on or contracted on a bilateral basis, you have exposure to your counterparty, largely offset by the use of collateral, but some people have pointed out that there is a small potential residual counterparty exposure, and regulators in particular this year have been focusing investors' attention on the collateral that's actually put in place to back that transaction, whether it's sufficiently liquid. In the last year in Europe, we've seen a number of commentators and the industry as a whole starting to distinguish between different types of synthetic ETF structure. So some use unfunded swaps where the ETF buys a basket of assets and then contracts a swap to swap the return on that basket of assets with the index return with a third party, and the funded swap structure where the cash coming into an ETF is paid across to a third party, and that third party gives collateral back, typically to a tri-party custodian to hold it on the fund investor's behalf. Also, there are some differences in terms of synthetic fund models. Some continue to use a single counterparty model, others have a range of counterparties in place. So there are some increasing distinctions being paid to different types of funds within this overall category. When it comes to securities lending, this has come up in some of the papers issued this year, notably in the IMF paper. There are some questions over the transparency, or rather the lack of transparency, when it comes to securities lending. Although it's stated in fund prospectuses that this can be, that the fund can get involved in this area of activity, typically there's quite limited actual information on who the counterparties are, what collateral is taken. There are some quite wide differences in terms of fee splits amongst different issuers, how much the fund investors receive from lending activities and how much is retained by the issuer or its lending agent. On securities lending involves collateral, and here again, there's as Brian has just pointed out, there are no Europe-wide rules in place for this. This is decided at the national regulator level. And again, when you're lending securities from a fund, you deal with counterparties, and those counterparty exposures are of potential concern to the investors in a fund. Cash reinvestment risks, when cash is taken as collateral and reinvested in assets that then turn out to go wrong, is perhaps less of a concern in Europe than it has been in the US over the last few years. That's just because of the nature of the securities lending market in the US. There tends to be a wider use of cash collateral, and in Europe, a wider use of assets as collateral. The fourth area of risk that regulators have been focusing on are broader systemic risks. In other words, what might happen in the ETF market that could affect the broader financial markets. This is something that, if you turn to the BIS paper that came out in April this year, you'll find described in detail. But the G20 Financial Stability Board and the IMF papers also focus on some of the same questions. The first concern they highlight is the possible use of ETFs as a source of financing for a bank, and this concerns ETFs that are issued by a bank through a subsidiary that is an issuer of synthetic ETFs. In other words, the ETF might be used, in the regulator's view, as a potential financing vehicle. Maybe there's nothing wrong in that by itself, except that the regulators are concerned that the ETF might be providing financing for relatively illiquid collateral. In other words, giving the bank funding against that, and that funding might then be withdrawn at short notice. There have been concerns raised, particularly in the BIS paper, about possible regulatory arbitrage. In other words, the use of ETFs, again, synthetic ETFs, to get around some of the Basel III plan restrictions on secured funding, and whether the ETF, if used as a source of funding, is being accounted for properly on that basis. Again, the BIS paper referred to what it calls the potential underpricing of the liquidity option. In other words, if a bank, through a subsidiary ETF issuer, is operating an ETF range, has the bank correctly priced in, or is it adequately monitoring the potential risk of the investors in the ETFs all asking for their money back, and the bank having to pay out lots of cash on a short-term basis. And another risk that the regulators highlight is the potential mixing together of the index tracking risk. In other words, the commitment a synthetic ETF provider might be taking on to give investors the index return with its own trading book risk. And these are all concerns that are spelled out in the papers from the spring this year. And liquidity, or ETF-related liquidity, has been a focus of recent warnings. The recent recent statement from the Australian regulator has picked up on this, and it's also highlighted in the ESMA discussion paper. The flash crash of May last year has perhaps opened or thrown open to question the actual liquidity in certain ETFs, and how liquid or how deep the exchange-based order book in certain ETFs is, and the potential risk for investors of trading far away from the underlying net asset value of the fund. This is something we've focused on in recent articles on our indexuniverse.eu website. There are some varying levels of exchange protection in Europe, or rules at the exchange level on how trading far away from NAV can occur or not occur in certain circumstances. So just before turning to our Q&A with our panelists, I'd like to focus everybody's attention on the discussion paper from ESMA, the European Securities Regulator, that came out in July. There's still one more week to go before they collect their final responses to the paper. And here are we've highlighted the key points in the ESMA discussion paper. First of all, they raise the question of how best to identify funds. And they're talking, as other national regulators have discussed this year, about a possible split of ETFs into so-called complex ones and non-complex ones. And this potential definition or demarcation of different ETFs is problematic in itself, because the UCITS category is designed to be a category that applies to non-complex funds, in other words, funds that are suitable for sale to retail investors. So if this is to occur, if we're going to start dividing things up into complex and non-complex, how does that leave UCITS? I think perhaps that's a question for Brian to comment on it in a second. The regulators are also talking about introducing different naming rules for different types of ETFs. So you could have a standard coming in whereby if an ETF is synthetic or physical or an active ETF, it has to indicate that in its actual name. ESMA has also talked about indices and the need for a clearer definition of index rules and how well ETFs are able to track indices. And if an ETF follows an index using an embedded investment strategy, that also has to have clear objectives shown. Synthetic ETFs, the regulators in Europe are talking about a disclosure of underlying exposures, counterparty and collateral, at least annually. I think that's an interesting one, because in practice several issuers are already disclosing on a daily basis. They're talking about enforcing CESA, that's the previous Central European regulators' guidelines on collateral, and that ETF issuers should spell out the possible effect of a counterparty default on investors. As far as securities lending is concerned, ESMA is talking about forcing issuers to disclose their intention to lend securities and to explain risks, and also to standardize collateral guidelines and in principle bring them in line with the guidelines for collateral for derivatives exposures. And to disclose the lending and agent relationship and fee split, but apparently no compulsory disclosure of actual collateral taken. Actively managed ETFs, the idea there is to mark them clearly as an active fund and alert investors to risks. Leveraged ETFs to disclose the leverage policy and explain how daily rebalancing can affect an investor's return. And I think this is an interesting one to finish up with, the secondary market policy. The regulator is suggesting that that ETFs have a risk warning, that investors are informed that their rights to redeem their funds are restricted. In other words, that they can't go directly to the issuer. As we know, ETFs are created through so-called authorized participants who have an intermediary role between the issuer and the end investor. ESMA is suggesting that there might be a possible introduction of the right for secondary market investors to redeem directly with the issuer. And I'd be interested to hear our panelists' thoughts on that. With that, over to our panelists, and I'd like to start with you, Alan. What are the key? We've been talking at length about different ETF-related risks. As an investor in ETFs, what are the key risks in your opinion? Alan, are you there? Gary, would you like to take that one?
Very happy to.
What are the key ETF-related risks in your opinion?
I think that at the high level, the biggest risk that ETFs have got is that they are, in future, with the benefit of hindsight, have been regarded as one of the biggest misspelling scandals that have ever existed. I mean, listening to your comments and in particular, describing some of the issues that have been raised by the various authorities. If you're an end investor, or even a relatively unsophisticated intermediary of the end investor, I just think you wouldn't have any awareness of any of those things whatsoever. And I think that really there is a very significant risk that if something were to go wrong, some counterparty fails or whatever, that we'll be looking back with the benefit of hindsight, thinking ETFs were the biggest mis-selling scandal into the retail markets. I know they're not particularly penetrated yet into the retail markets, but I think that's the single biggest risk. I know that's not really the direction of the question that you asked me, but if I answer the question from a general perspective, I think that's what it is. We might be staring at one of the biggest scandals in financial services history.
Brian, any thoughts on that? I mean, do you think that there's a potential mis-selling risk in the way some of these funds have operated over the last few years? Brian, are you with us? I think you may need to unmute your phone.
Okay. Yes.
What's your thoughts on what Gary just said? Do you think there's a potential case for mis-selling in the way some funds are being marketed in the last few years?
Well, I think there's merit, Paul, in some of the concerns that the various bodies you mentioned to have in the context of disclosure. Certainly in the context of the synthetic ETFs and where they're being sold to retail investors, there should be greater disclosure probably in terms of the various risks, be they the counterparty risk, the event of default, what happens, the risk of the collateral that remains, the risk of selling the collateral. These are probably they probably should be disclosed in greater detail in offering documents. But as you mentioned yourself, a lot of the synthetic ETFs, the vast majority of the shareholders are institutional and not retail, certainly in the European perspective. But certainly, if these are going to be sold to retail investors, I think there does need to be greater disclosure around the risks, and also perhaps in the physical replication where securities lending is utilised, so that perhaps in both models that there should be greater disclosure.
Brian, can I ask a follow-on question at this point? This begs the question: you sense it from some of the points that have been written in the ESMA paper, but how comfortable are European regulators with what's been created under UCITS? Have they created a monster that they're now a kind of Frankenstein monster they're trying desperately to disassemble, or are they worried about what they've created?
Well, I suppose there's a number of points that I'd raise.
Hello.
First off, the point I would make is that ETFs, in some cases, are no different to any other type of UCITS, where they use total return swaps. So total returns are not exclusive to ETFs. So the points that are being raised here are probably applicable also to other types of UCITS product. The second thing is that there are very prescriptive rules around the use of collateral. We've seen that in the context of derivatives, and so I think in the context of the fully funded total return swaps, that there are very specific rules about liquidity, valuation, the rating. Yes, in a worst case scenario where you have to sell the collateral and there's a run on, I think some of the papers mentioned, where there's securities loaned and they're called by the ETF providers in order to meet redemptions. There are scenarios where there could be liquidity issues, but generally what I would say is that there are prescriptive rules around this in terms of collateral, at least. Maybe not so on the securities lending side from a European perspective. But I suppose on the other side of the coin, if you look at you mentioned the non-funded total return swap, where there's a basket of securities, and obviously they are a basket of securities that's generally purchased from the counterparty, and the return is swapped for a return on the index. And obviously that basket of securities that's provided by the counterparty, essentially there are no minimum rules for those, because ultimately they're not seen as collateral held by the fund, but are seen as assets purchased by the fund, and therefore, but they could be below investment grade. They could be, there's no credit control in terms of those. But they would have to be consistent with the investment policy as disclosed in the offering document, and therefore one would expect the investor to appreciate that, what is proposed. But again,
Brian, may I just ask you to share your thoughts on whether if the regulators are talking about splitting the market into so-called complex and so-called non-complex funds, is it likely that we'll see half of the ETF market being deemed unsuitable for retail investors? And if so, how might that occur? Are we going to see certain types of fund split off? Which funds might those be?
Yes. Well, I think there is the possibility of having UCITS treated as non-complex product, complex products. Because currently, if you look at it in the context of selling UCITS within the European market, at least, that we see that where for purposes of execution trading, that the UCITS are considered non-complex products, and therefore there's no onus to ensure that the UCITS is appropriate for the purpose of the investor vis-a-vis their experience and their knowledge. So I think there is a move on the European level to treat UCITS as complex products with an obligation, therefore, on service providers who are executing trades to ensure that these products are appropriate for the investor. Specifically in relation to your question, I hope the regulatory bodies don't go as far as making these products not available to retail investors. I think there is, there are a number of other mechanisms where they can be disclosed. Greater disclosure, maybe treating them as complex products where there's a greater onus on the distributor or the service provider executing the trade to ensure that the product is appropriate or suitable depending on what service being provided, and that is a means of addressing the concerns that the regulators have, as opposed to prohibiting these products from being sold to retail investors.
Okay, so we might end up with stronger. Yes, please come in, Alan. Yes.
Yeah, I think, obviously everybody here is concerned with ETFs, but what seems to be completely and utterly forgotten by particularly the FSA is that if you actually look at retail products across the board, here they have, one of the largest selling IMA sectors is absolute return funds. I've got an £8 billion fund in front of me, which is involved in high yield credit, Mexican rates against euro, Russian equities, SMI versus DAX, US forward, start duration, 20 other similar strategies. There was no explanation whatsoever of the precise counterparty risk, the precise collateral risk, and that is deemed suitable for being sold to retail investors, where it's inconceivable in my mind that the vast majority of investors can actually understand how it works. And yet on the ETF side, they seem to be singling out ETFs without looking at the other 95% of the market, where there's equal risk and virtually no disclosure whatsoever to investors on a proper basis.
Yeah. Well, Gary, what do you say to that? What would you say to that suggestion that there's not a level playing field between ETFs and other types of funds that are approved for sale to retail investors?
Well, I certainly agree that obviously this thing applies to ETFs and to non-ETFs. UCITS stuff spans across the whole piece, so there's no difference there. And there are some bad ones that are not ETFs as well. There's certainly the comments that are being made are not being made of those at the moment, so I would agree absolutely with Alan on that. But I go back to the first point, which is I think that the regulators generally have really lost the plot now on some of this stuff, and I think the industry has lost the plot as well, because it seems to me that, and I'm sorry that I'm disagreeing with you, Brian, but this isn't about disclosure. There is absolutely no way that any amount of disclosure would allow the end retail investor or many intermediaries to understand the risks that they're taking when they're investing in these products, whether they're delivered in ETF form or otherwise. And I think the fact that the system, the regulators and the industry have allowed that situation to develop has completely undermined and destroyed the UCITS brand, which effectively was a sort of tick in the box that they were instruments that were safe to be used by end investors. But UCITS funds are just not like that anymore.
Brian, any thoughts on that comment?
Well, I suppose the long-only UCITS product is long gone. We've had UCITS as a result of the UCITS 3 introduction, and the ability to use absolute return strategies within the UCITS. So I mean, the UCITS has evolved, and I suppose what the important point is that there are risks, I suppose, related to that. And I suppose the regulators like to think that they can monitor it and manage it by virtue of the rules that they put in place and the risk management processes that need to be put in place around these structures. But I would agree with one point, that is that there are plenty of non-ETF UCITS funds that have probably a greater level of risk in terms of the strategies they're utilizing and the degree of leverage that they may be generating. But I mean, ultimately, I think the UCITS product, it's a worldwide brand. It's working at the minute, but I think it's important that if that was tarnished in any way, that would have a major impact on the brand. But I don't think in any way that this is exclusive to ETFs compared to other UCITS funds.
Yes, the problem is the regulator
yes,
currently, I mean, the comments from the FSA in June, July were really astonishing, because you would have thought that the head of a regulatory body would make a balanced and objective comment after research. So to actually say that certain products may be deemed unsuitable for retail investors without looking at all the other products which are currently deemed suitable for retail investors and without comparing on a like-for-like basis, in my mind, is absolutely astonishing. At least the European regulator is actually consulting participants, looking at the industry kind of objectively, which is unfortunately not seemingly kind of taken the place. We've had this huge level of noise in the last 2 months about synthetic versus physical ETFs, where arguably you could say actually it's a similar risk. It's collateral and counterparty just dressed up in different ways, whilst the FSA is completely ignored the securities lending in mutual fund, where I've looked at the rules, and basically the rule says there are virtually no rules. You can lend up to 100% of the portfolio. It doesn't really matter what you put against it as long as it's adequate, I think is the precise word. And in terms of the counterparties, as long as they're kind of reasonable. So at least, Brian, the Irish regulator has actually got kind of firm standards in terms of credit control, but we don't actually have that in the UK at all. And it would be nice if the FSA could actually raise standards across the whole industry and have a level playing field so that the investor actually wins. What is going to happen from these comments is it's going to put off people, ironically, investing in the area which tends to have the highest transparency, the lowest fee, the greatest spread, and investors normally end up with the highest return. That is what mine has been lost by the noise of the last few months, is the virtues of the ETFs. Of course, some are better than others, and some physical are better than some synthetic, and vice versa. But as long as the regulator actually ensures there's transparency of information on a timely basis to investors, then investors should be allowed to choose.
Alan and Gary, could we talk a little bit about liquidity of the liquidity of ETFs? There have been some comments recently that by regulators that it's difficult for investors to work out what the intrinsic value of their fund is when trying to buy or sell an ETF in the secondary market, and that there's a risk of trading far away from NAV. What's your perception of liquidity risks in ETFs, and what might be done to improve things when it comes to working out whether you're getting a good deal? Perhaps, Gary, we could start with you.
Yeah, I think that if you're a small investor, you've got to rely on the fact that the arbitrage mechanisms are working properly. You really can't tell whether they are or not from the outside. As long as that market's working efficiently, of course, then the arbitrage mechanisms should be working properly, and you should end up with a situation where the secondary market price is close to NAV at all times. I think the bigger liquidity worry is what happens in times of stress, and I think we had in the what we were calling the last financial crisis, issues where certain ETFs that became very illiquid in themselves, in the sense that they couldn't be traded very easily at all in any size. So I think that's actually the bigger liquidity issue, rather than the issue that from time to time they might move away from NAV.
So it's the actual disappearance of liquidity during stressed market conditions.
Correct. I think that's the bigger issue.
Yeah.
But you can't.
And Alan, what are your views on the subject?
Well, actually, I mean, there are one or two ETFs we've looked at where actually the spread has been quite significant and changed dramatically during the day because it's based on the US index and it was a relatively small ETF. So if you were a private investor, the danger in that one would have been you could have bought it at 9:30 in the morning and basically paid 2% too much. And I think so some of the manufacturers say, well, actually, that's not a problem because you can buy through a flow agent or whatever. But I think you should ensure all investors are treated equally, and that at times during the day, there's a tight market in your ETF, thereby benefiting everyone uniformly. And it's something we look at.
And whose responsibility should it be to inform investors of the risk of trading away from NAV? Should it be the issuer's responsibility, the exchanges? Should the regulators get involved?
Well, I mean, you can argue, I mean, is this anything different from an investment trust? An investment trust, you could buy an investment trust, couldn't you, and go to a 5% discount to the NAV and then a 10%. I mean, as long as it's kind of, and it is made, I think, reasonably clear that the price normally performs in line with the asset value, but there can be differences. And maybe, I mean, I suppose there could be a rule that if the average spread was greater than a certain percentage, you would have to kind of put that as a risk within your...
What do you think about the ESMA's proposal to possibly to allow investors to have the right to redeem directly with the issuer? Would that work in practice?
I mean, I don't think it necessarily it's a bad idea, although sometimes you can actually find it can actually be cheaper at dealing in the secondary market, particularly with things like stamp duty on UK shares and ETFs, and actually redeeming through the the participant. But it would make them more akin to, I suppose, the mutual funds in the UK, and thereby probably make it more accessible to the general public, which is a good thing, because the general public is not really being properly told about this way of actually having your money more efficiently managed in a greater spread of assets at a lower cost.
Gary, any thoughts from you on the proposal for investors to be able to redeem directly with the issuer and how that might work in practice? Would that raise costs on funds, for example?
Well, everything seems to raise costs. But
yes,
almost every innovation raises costs to the end customer. I think if we were able to get to the stage of having continuously priced mutual funds, which is effectively what you would have in that situation, then in itself that would be a good thing, as long as it didn't increase costs, which I doubt that would be the case, or increase risks, which again I would doubt would be the case. I mean, for most retail investors, the reality is they don't need to use ETFs at all. They should buy mutual funds that are priced on a daily basis and hold it for the 25-year time horizon or whatever it is that they should be investing for. And the daily liquidity or the immediate pricing aspects of ETFs are pretty irrelevant. But in itself, if it can be achieved without cost and risk, yeah, it would be a good thing.
Well, another question for the two of you as investors. What do you think about the recent announcement by BlackRock in the US that it's applied to register some of its own indices? Do you think that's a good idea?
I mean, I don't think it's a bad idea. I mean, I think it's like every single ETF. You look at it objectively on the basis: do you actually want to invest in that index? So if their index, I don't know what it is, but if it's very attractive and you like the characteristics of anything, basically your investor's going to make money investing in it. That's the most important thing. Then I don't have a problem with it, whether it's called the S&P 500 or the value 500.
So it's not a concern that it's not designed or calculated by an independent entity.
Well, I think you can. If you're looking at a mutual fund, I mean, the risk in the mutual fund is a quantum of that, isn't it? Because you don't even know the whole portfolio. So if you're going to start worrying about that, I think there's plenty of other things to worry about first.
Gary, any thoughts on indices and who designs them? And
bespoke indices, let's say. I mean, you're moving towards a place which is active ETFs, and I think the idea of active ETFs is silly. But it's starting to move in that direction.
I disagree with that, but anyway.
In itself, if it just provides more choice to investors, they can make their decisions on the back of it. But I would be very worried that any bespoke, if I can use that phrase, indices that are then tracked using an ETF, there's all sorts of ways for the index constructor to create opportunities to create additional money for himself at the expense of the end investor.
But I mean, let's take the example of Mr. Gross and his total return, or what it's going to be called, ETF. Now, if an investor in the States wants to buy the lower cost ETF rather than the higher cost mutual fund, I'd have thought, and be able to see the whole portfolio daily, be able to deal whenever they want to deal, and have the same manager, similar portfolio, I'd have thought, that's pretty attractive. I can't see a problem with that. If they want to buy the US tips instead as an index, or the active PIMCO, that's, it's giving them more choice, and it's doing it with some of the qualities of the ETF world, which is basically cost and transparency, which are not available, unfortunately, in the world of mutual funds.
Brian, can I ask you a question on the role of European versus national regulators? You've talked about collateral policy being set at a national level, and I've been aware in the past of different collateral rules opposed for Dublin-based ETFs, other collateral rules for Luxembourg-based ETFs. How likely is it that we end up with a standard set of rules across Europe, or are we still going to have lots of little national loopholes in place?
Well, to be honest with you, I was quite surprised that there was that there wasn't much prescriptive rules around the securities lending. I suspect, and I don't know for sure, that Luxembourg probably have very similar rules to Ireland. But I suppose, and they are the main exporting countries from a UCITS perspective. Obviously, according to Gary and Alan there, the FSA is behind a little in terms of the rules regarding securities lending. But I would suspect that as I said, that Luxembourg would be similar to ourselves, and I can't speak for the other countries. But there wouldn't be too many. There wouldn't be. I don't think there are many. Like, if we think about ETFs specifically, and the structure of those of ETFs, whether synthetic and the rules are all very much are prescriptive enough in terms of the use of derivatives and the collateral and the rating of the issuer, the collateral issuer. So it's the securities lending was the one area that it seems to have fallen down, and perhaps this is one of the areas that ESMA now will take on board and prescribe at that level. So I would be surprised if there's no movement on that, because I would very much expect it.
It looks in their discussion paper as if they're going to try and enforce the same rules for collateral in securities lending as they have for collateral in derivatives-based funds. So on the basis of what you're saying, that would make sense.
Yeah.
I mean, they seem to be more sensible than, unfortunately, the FSA, who seem to follow a flat earth view of the world, and they look at one product against another.
Gary and Alan, if I may, a final question for the two of you. Perhaps you first, Alan. What if you could list your top 3 requests for that things need to be improved or disclosure requirements improved for ETFs? What would they be?
Well, I would have said, first of all, I mean, the easiest thing would be to not have this 10% counterparty risk. So simply ensure that all UCITS funds have 0 counterparty risk. So that would actually make it more even between physical and synthetic. But in terms of transparency, I think all ETFs should disclose daily, if they're synthetic, what exactly the collateral is, and if they're physical, exactly who the major counterparties are, who the borrowers are, and who the assets are by fund. So then people can then actually judge by fund, because that's what people invest in, what the risks are for each fund. And at the moment, some manufacturers do more than others, but why not just uniform it across the board? You have to have 100% collateral, and you have to disclose your collateral and counterparties.
And Gary, what would you like to see brought in?
Well, I think it depends who I am. If I'm representing the business that I am, then I'm quite happy to see lack of disclosure and complexity and all sorts of difficult things, because that creates a role for the sort of business that we are. But if I'm wearing my end consumer hat, I think that the best thing that the regulator could now do would be to rip up this nonsense called UCITS and reinvent new UCITS, which actually is the seal of approval for the sort of funds that retail investors should be feeling comfortable is relatively safe to invest in.
Right. Well, some very provocative thoughts at the end, and an interesting one, and sounds like we're in for some upheaval if that's going to be the case. But well, unfortunately, we've run out of time for questions. I'd like to thank Brian, Alan, and Gary for a very interesting half-hour debate. I'd like to thank all of you for listening in. Just before we finish, a reminder of our forthcoming webinar in October on getting best ETF execution. That's on the Thursday the 20th. You can register on our website. With that, our hour has come to an end. Thank you all for participating.
Okay, thank you.
Thanks. Bye.